Hi everyone. Hope all good. All right. Give me a second. Let's see what we have for today. Sorry guys. I don't know why your system is. All right. What we're gonna see in today's classes: principles and assumptions of accounting. See, there are many principles and assumptions of accounting. However, as far as part one concerned, we're gonna learn only this four. All right. The very first one is revenue recognition principle. What does it mean, revenue recognition? Under this concept, revenue recognition, we recognize the income, we recognize the revenue, not when we receive the money, not when we receive the money physically, but when we provide the goods and services. Let me tell you this with an example. All right. Let's say I have a computer manufacturing business. I produce computers. One of you guys come to my office to buy a computer. All right. You came to my office. You're sitting in my office, but I tell you, you know what, Praveen, I'm sorry. I don't have computers. It's still under manufacturing. It will take another week for me to give computers to you. All right. So you say, see, dude, I can't keep coming to your office. I stay very far from you. So what I'm going to do is I'm going to transfer the money to you or give the cash to you in hand. You can send me the computers directly to my office address. Now I receive the money. I have the cash, like let's say physical cash. You, Praveen, gave me the cash to me. Can I consider this as my income or revenue? No, not under this concept. The beauty of accounting is see how legitimate it is. They have written the concept of accounting very beautifully. I cannot record this just because I received the money. I can record this as a revenue only when I send the product to you. Until I send the product to you, your money becomes my liability. It's an unearned revenue for me. All right, that's a liable. I have to pay. I have to give the product to you. All right. See, no matter what, at any point of a time, you can file a case on me because you have paid the money and you have all the proof. Correct? So now let's see the other side to the story. The other side to the story, you come to my office and I, I give you the computers, but there is something wrong with your bank network. You're not able to transfer the money to me. So what I'm going to tell is it's consuming time for both of us. You leave for the day, you take the computers with me, go home. Once your banking network is good, send me the money. All right? Did I earn the money? Yes, of course, because I've given the product and so I've given the product to you, which means you have to give the money to me, right? That's fine, but I've given the product to you. No matter what, I can file a case against you at any point of a time. If you don't give the money, that's going to go as a bad debt to me. That is fine. But as far as revenue concerned, I have earned it. I've given the product as I promised to you. Then, therefore, I can recognize this as a revenue. Hope we are clear on this concept, right? Let's move on to cost principle. What is cost principle? Doesn't the word itself explain what is cost principle? Under this concept, let's say you buy a truck for your business worth of, like, you buy a truck of you and you pay 10,000 rupees for the truck, and you go to your friend who's good at cars, who know truck very well. He drives your truck and he says, dude, how on the earth you got this for 10K? This is worth of 20K, right? And you take the truck to your relatives and friends and you show it to them. Even they say the same thing. This is worth of 20,000 rupees, but you just gave 10,000 rupees. See, we're not going to get the truck for 10,000 rupees. I just took it as an example. However, now you paid 10,000 rupees for the truck, but it's worth of 20,000. Okay, what is the amount that you have to put it on your books of accounts? You have to put 10,000 rupees. Doesn't matter how much your truck is worth of. It can be a worth of 1 crore. You have to account only what you paid for it. That is cost principle. Got it? And next we have is matching principle. See, under this principle, let's read this for a change, right? It requires that any business expenses incurred must be recorded in the same period as a relevant revenue. What we understand from this? Now, let's say the revenue that you earn for a year, like let's say 2024, and the expense you spend to earn that revenue should be recorded in the same period. Now, let's say you have an ice cream shop and you paid a rent for this ice cream shop for the year 2024 from Jan to December, and the rent per month is 1,000 rupees. You paid 12,000 rupees. When it comes to expenses that you did in the month of Jan, when you're calculating the revenue, when you take the revenue for the month of Jan, your expenses, your rent expenses should be just 1,000 rupees, not 12,000 rupees. You paid in advance, that's your prepayment. However, you have to calculate the expenses for that particular month is just 1,000 rupees. Clear? And the next one you have is, guys, I want to tell you something. I don't believe in putting the fancy descriptions. What I believe is understanding the concept. If you understand the concept, no matter what, you can explain it in your own words. So, see, if you understand the concepts, whatever the problems, whatever the transactions under this, you're going to get it in the future. You can analyze, right? That's why I put this. If you see it on my screen, it's all written by my own words. It's just that I've understood and I've put the concept. I want you to. I have the same expectation towards you. Now, the full disclosure concept. What is full disclosure? The word itself explains. In your financial statement, okay, let's say your accounting information should have a full disclosure. You have to give a full disclosure. You should not hide anything when it comes to your financial statement. Now, let's say you have a lawsuit. Now, something happened with your business. Somebody filed a case against you. There is a lawsuit coming in the next 3 months. The case is in the court. It can come in favor of you or not in favor of you. If it does not come in favor of you, you have to pay some amount to the court or to the guy who filed the case. You have to disclose. You have to inform. You have to narrate that in the financial statement. You have to keep the stakeholders informed about it. You cannot just hide it. So you have to say every other information in the financial statement. That's called our full disclosure concept. I hope we are clear on this one.